Thanks for tuning in to this live recording of the Resilient Advisor Show. My name is Jay Coulter. I'm about to record an interview with Michael Guyad, who's a regular on the show, and we go through some of the factors that he's seeing in the marketplace from a risk-on and a risk-off lens. If you have questions during this interview, please feel free, if you're watching on Twitter, Facebook, YouTube, just pose a question in the comments and I will get it over to Michael. So right now we're going to start recording this interview.
Our mission at Resilient Advisor is to have a significant impact on the retirement crisis by educating and empowering financial advisors to better serve their clients. We bring you industry thought leaders and experts to help you make a difference in the lives of your clients.
Thanks for tuning in to this episode of the Resilient Advisor, now part of the new Financial Advisor TV network. My guest for this interview is Michael Guyad, a regular. He is the publisher of the Lead Lag Report and a portfolio manager at Toroso Investments. Michael, thanks so much for coming back on.
I'm glad that FATV is starting to take off, my friend.
Yeah, we're very, very fortunate. Let's get right to it. So the reason this has been a great regular broadcast for us is we try to break down how you're looking at the markets through a risk-on, risk-off lens. I want to make sure that viewers know these are not trading signals for today. Michael is the portfolio manager of the ATAC Alternative Mutual Fund, of the ETF RORO and JOJO, and these are meant to be long-term allocations to strategies that have a risk-on, risk-off lens. So with that, Michael, let's start with what people are talking about today. Let's talk about ARK, IPO, and some of the challenges that they've had here recently.
Yeah, look, I think it's very telling as far as whether somebody is really a long-term investor or not. If they talk about innovation and all the great things that are coming in the future, and somehow they sell ARK because, it's down for the month or for the quarter. And I'll tell you, this is sort of a problem across the board, right? People's attention spans are increasingly shorter. There is no such thing as a true long-term investor because everyone is being inundated with noise, which makes them want to act. And because we live in a small sample, the reality is most people tend to not understand that if you're going to make an investment, that's supposed to last for more than a few months. Now, ARK's had a lot of outflows. I will tell you, as the portfolio manager of the ATAC Rotation Mutual Fund, which was up 72% last year, doing it differently than ARK, I've seen outflows too. Mutual fund was up 72% last year. Now it's, as we speak, it's down around 8-9%. On the one hand, it's kind of like Crimea River, right? After being up so much. But my own assets in my own mutual fund went from 361 in February down to 194 because people seemingly can't stand to stomach the idea that the S&P, which is the only game in town this year, where it's a pure risk-on world in large caps, they can't stomach the idea of diversifying. Meaning having things in your portfolio which aren't working in unrelenting bull periods on the hope that they work in unrelenting volatile periods like 2020. ARK is a different animal, obviously, but my broader point with ARK, with IPO, is that I've always had this long-held belief that the volatility of assets in funds is a lot higher than the volatility of actual performance. And that's a really damning thing, I think, to the investment community when it's like that.
Well, it's the reason some hedge funds gate so that they can manage through difficult periods. And, I've been in this industry since the 90s, and it's amazing where people will only look at risk mitigation strategies after the horse has left the barn. And then they pile into it, and then they don't perform, the S&P 500, and their clients are knocking on the door trying to pull them out. Michael, as a financial advisor who's building portfolios with these types of tactical strategies that provide risk mitigation, how could advisors keep their clients in these types of strategies so that they are protected when risk shows itself?
So this is I think the great challenge, right? Because every advisor has to decide, are they going to be true fiduciaries and do things in the best interest of their clients, even if their client disagrees? Or are they going to do what their client says, even though they know that it's probably not in their best interest, just to keep the assets, right? To keep those fees. And listen, the reality is I sympathize with the latter view because the reality is as much as separate account financial advisors may want to feel like they're in control of their clients' assets, it's the client's assets, right? They can only do so much. So I do think the correct answer is the hard one, which is that there's a degree of anti-selection that has to happen when thinking about the types of clients you end up keeping longer term. I get it, right? When you're smaller and you're an advisor and, revenue is hard and getting clients is hard, you've got to kind of acquiesce in the moment. But if you have clients that are not long-term, and if they complain about every single position in a portfolio, if it's not green, you might want to consider getting a new client. It'll save you as the advisor more of a headache and maybe even some liability risk than having somebody that's going to just simply be very short term. And then they're going to blame you and say, why wasn't I more diversified? Well, because Mr. or Mrs. Client, you told me I don't want to, not to hold this particular position, which wasn't doing well when markets are doing well. So I get it. It's a hard thing, but I think the only real answer is you have to just try to make sure your client base over time really understands. And there are a few that do.
And I think there are a couple of tools advisors can use. Obviously, an investment policy statement, if your practice is built well enough, can help with that. But once they sign it, they forget about what you talked about. So you have to bring it up in client meetings. One thing that I've really started to see take hold, especially folks that trade on something like, say, Orion or InvestNet, is they create a risk mitigation sleeve and they diversify their diversifiers. For example, taking a RORO and then some other ETFs that might have different types of risk return profiles and putting them into one risk mitigation sleeve and then educating on it.
Yeah, and I think, but part of that also is the advisor recognizing that they should not themselves thinking about timing risk and risk mitigation. Risk mitigation should always be there in a portfolio. I always go back to that analogy. I don't know the mile marker I'm going to crash my car. I know the conditions. Or risk mitigation is basically just saying, okay, I got to always make sure that I have brakes that are working. Right? That's real risk. But again, because you don't know which one it is, so you don't know when that moment occurs. I get it. A lot of advisors, they have this temptation to want to time, hedges rather than have something that is quantitatively driven in trying to do those rotations like RORO, like JoJo. But yeah, I find a lot of advisors will say things without actually testing if what they themselves are saying has merit. So you're better off just saying to yourself, okay, I've got my passive up capture only type of portfolio as my core. Then I've got my risk mitigation satellite. And if that lags, that's the cost of insurance for when things really hit the fan.
I cannot believe in a year of doing these broadcasts, that's the first time I've heard that analogy. I love it. All right, so let's get into some risk signals. I prep for my shows with Michael Guyad by jumping on his Twitter handle. If you're listening to this on a podcast and you're on Twitter, you need to follow Lead Lag Report. That's at Lead Lag Report. Michael, I'm going to read a tweet for podcast listeners that you put out yesterday. The yield on the 10-year U.S. Treasury has jumped from around 1.3 in late September to 1.5 in early October as sustained inflation and an improved jobs market increased expectations the Fed is going to taper its $120 billion bond buying program, which has depressed yields and debts. The 10 years becoming a problem, Michael. What do advisors need to be thinking about?
Well, first of all, keep in mind, we should all want to see higher yields. I'm just taking a step back from the concern about what it means for the markets overall, right? You want to see higher yields because it means the cost of capital means something. It means you're actually getting some kind of potential return. Yes, it's still negative real return because inflation's still higher, right? And I can make a case to you that given the way inflation expectations have been behaving, that yield should be a hell of a lot higher unless inflation expectations are wrong, which is just sort of a side note. We have this kind of interesting tug of war between absolute yields and inflation break-evens within the bond market itself. But, one is don't be afraid of yields rising. You want to see them rise. Two, if the reason that they're rising is because of growth/inflation, and often the two will come together, but not always, well, that's what you want to see because that means your stocks probably benefit. That means your commodities probably benefit. The problem with rates is always much more the speed with which a yield move occurs because the bond market and interest rates are so intertwined with so many aspects of the economy. You have to allow economic participants time to position for higher rates. If higher rates happen overnight, that actually becomes, I would argue, more of a disinflation, deflationary shock. If they're gradual, then people can prepare for it. Companies can prepare for it. That's not necessarily a bad thing.
So then to be clear, through your risk off, risk on lens, like how do we look at the 10-year as we sit today?
Usually when you see the yield curve steepening, which is what's starting to re-happen again, that tends to be beneficial for risk on conditions. By the way, that's confirmed with utilities weakness, very short term, which flipped a couple of weeks ago. That's confirmed with lumber resurgence, which just started to take place after being deeply oversold following the crash. It also tends to coincide with small caps outperforming. That still has yet to be seen. But as much as things are still, people are concerned because, we had a 5% correction. 5% is not a correction. That's noise. We had this 5% decline in September, and everyone's worried about October. At least for now, I would argue that the risk signals are still we're still kind of in a sunnier environment. That's not to say you can't have an accident, but the odds are probably lower. And I do think that if the reflation narrative kicks back in, and you're seeing that with outperformance in financials, you're seeing that with outperformance in materials, you're seeing that with outperformance in energy, while tech itself is starting to lag a bit relative to those sectors. If you see that shift away from growth to value again, which I think is what's really happening, kind of like a repeat of earlier in the year, okay, that can be another reason for another leg higher. And again, a leg higher probably in those areas which have not participated, primarily small caps, emerging markets.
Yeah, you've been on this Russell 2000 and watching that for the risk on lens on Twitter. And I'm curious, as a financial advisor or portfolio manager, what specifically around the R2000 do we need to be looking at?
Well, the thing with Russell 2000 is that it's gone sideways since February, right? So you haven't really had new highs. You've had a lot of churn, a lot of volatility Monday through Friday, but not real actual movement. So you've had this prolonged sideways consolidation period. The question is it distribution or accumulation? From a technical analysis perspective, meaning, is it the sign of a top or is it the sign of a bottom and then suddenly like a bottom, given how long it's taken, and then a move higher? Given how much the S&P and large caps have moved, my argument would be that the spread between large and small cannot persist the way it has this year. So one of them has to converge. It's either going to be small caps on the way up or large caps on the way down. If we're in a risk-on environment, it's probably going to be more small caps. If we're in a risk-off environment, it's probably going to be more large caps. Just directionally, it's a question of which one is favored. But, again, if you're going to be bullish on equities here, I don't see why you'd want to do it in the FANGs. You'd probably want to consider the areas which haven't moved.
So from a technical perspective, small caps look positioned if the market's going to move higher to outperform large caps in the short to intermediate term. Is that fair?
Yeah, and I think there's a potential for a breakout in that from that very long sideways consolidation. If that happens, yeah, sure, you could get kind of a manic close to the end of the year. I don't know if large caps will give you much more oomph. I just think that there's more catch-up potential, right, in the smaller part, which has failed to participate.
Excellent. I want to thank Tammy for tuning in. She's happy we're going over this. Tammy, I hope you also like it when we talk about gold and silver. Michael, I'm going to pull up a chart, 1 year returns for both of those. When you look at them from a risk on, risk off, what are they telling you?
So keep in mind, it's a little bit tricky with silver to gold as a ratio, right? So generally, the idea is that when silver is outperforming gold, because silver, which is often called poor man's gold, is performing, that would suggest that industrial activity is picking up, right? Because silver is used more in industrial applications than gold is. Mm-hmm. So silver's largely kind of gone round trip, right? Has underperformed quite badly gold. But again, these things go through cycles. So on the one hand, you'd say to yourself, well, silver to gold actually would suggest that there's going to be a slowdown and some of this disinflationary fear might come back. Or, again, we may have already passed that. The ratio itself could start to turn up, and then that would also be confirming a sort of an offensive environment. But it's not clear. Again, silver to gold is worth noting as a relationship, but it's not something that's as clean of a risk-on, risk-off tell as things like lumber to gold, as things like utilities against the market, as things like long-duration treasuries against intermediate.
Now, I know a lot of your team over at the ETF think tank are big believers in Bitcoin and its place in a portfolio. Are you still a skeptic as it relates to that asset class?
No, I've never been a skeptic. I've been a skeptic of the narratives.
Okay.
Right. I mean, the narratives, right? Just all these arguments about stores of value when there's kurtosis and there's tail risk and this idea that, any one cryptocurrency will eat the world. It could all be true, but I always go back to my default, which is coming from a place of humility. I don't believe anybody knows what the future holds. That includes maximalists. So you can have a belief in an investment, but you can't have a religious fervor around an investment because that implies that you know exactly what tomorrow brings. I just don't believe anybody does. Again, I think it makes sense potentially as a portion of a portfolio. I've always made that argument. I think waiting is critical in any investment. And I think questioning narratives is how you figure out just the right weighting to take on in a portfolio of Bitcoin or Shiba, as the coin, which I've been joking about on Twitter recently.
So your partner at Taroso Investments, Michael Venuto, has been on a couple times, and he actually has some great lines about it. And, he's one of the co-portfolio managers of the Block ETF, BLOK. And he says right now, this is going to be the Internet 2.0, but we might be in the pets.com era of Internet 2.0. So with that, doesn't that speak exclusively to using technical analysis instead of any type of fundamental analysis when you look at that asset class?
To some extent, but keep in mind, a lot of these cryptocurrencies are fairly new. It's hard to really test anything quantitatively in terms of buy and sell signals. I think there's a logic to the idea that emotion is what drives it, and probably, I hate to say it, more manipulation on sentiment, because you'd see that with some of these fake Twitter bots that just constantly come out there and try and pump particular meme coins. So yes, in the absence of knowing how to value any of this stuff, the only thing you have is a chart. The only thing you have is price behavior. Again, my hesitation is purely that you don't have a large enough sample to actually know. If you did technical analysis, a moving average, you did multiple oscillators, if you did those signals multiple times over multiple rolls of the die, if you'd be any better off. That's the question. And we only know that going forward in time with more data at our back, but it's a bit of a leap of faith at this point.
All right. So, Michael, we've got a question from a live viewer. Tammy LK would like to know if you could go over consumer staples and your thoughts on them today in the market.
So staples very much tend to correlate to utilities, right? Meaning that when utilities outperform, you'll see consumer staples outperform. And that's because they are defensive areas of the stock market. They are more based on need than want. Staples are still weak relative to the market, just like utilities, right? All the action remains either in this switch from growth to value, tech to financials, energy materials, not so much from those areas to staples, utilities, healthcare. Now, I think they are very oversold on a relative basis, meaning that in general, there's probably an under positioning in defensive areas. Consumer staples are part of that, and dividend areas in general. So they're probably going to see some alpha, some outperformance, but if this momentum continues on the risk on side, it's going to be hard to sort of say, well, that's the place I want to make big gains from. If you want to grow steady, there's nothing wrong with that, and that plenty of evidence shows that that's a good way to make money.
Excellent. Thank you for the question, Tammy. Michael, let's wrap up with this. Earlier today, you had a recording with Chris Davis of Davis Advisors on the Think Tank Exchange, another great deliverable from the ETF Think Tank. Tell me, did you learn anything today in the conversation with Chris Davis?
I learned I need to have more powerful friends like Chris. No, it's look, I mean, I have a lot of respect for everything that Davis has done, obviously. I mean, incredible story, family lineage, very much are big on incentives, right? And making sure their employees are very much aligned with the firm's goals. If anything, that's probably the most important dynamic that I think is not so much something I learned, but more of a reminder of, right? If you want to really build a world-class organization, you got to make sure everybody's on the same page. The only way to make sure everybody's on the same page is everybody's in the same kitchen, doing the same cooking, eating the same food.
Yeah. I got to tell you, Michael and I were talking before the broadcast, and I was sharing with him that in the 90s when I got started, I mean, Chris Davis was a legend then. The families were great at what they do because they've stayed on point. They are humble when they make mistakes, and they're just really, really good asset managers. Michael, I appreciate you coming on for another episode of Risk On, Risk Off on the Resilient Advisor Show, and we'll talk to you next month.
Yeah, pleasure. Thank you.